Let's discuss business combination achieved in stages. Otherwise known as step acquisition, business combination achieved in stages happens when an investor acquires additional shares from an investee which it had previously held equity interest, and the additional shares purchase results to the investor obtaining control over the investee. The investor is already a shareholder of the investee, which holds ownership of equity that is below 50%. Therefore, the ownership of such equity interest does not give the investor control over the investee. So it's either a significant influence or none at all. So, upon the additional purchase of shares by the investor, there is a business combination that is achieved in stages or step acquisition when the additional shares purchase enables the investor to obtain control over the investee, which means that the additional shares purchase could increase the percentage of ownership exceeding 50%. At the time the investor obtained control, the acquisition should be accounted for as a business combination. So let us illustrate the accounting for a business combination achieved in stages or step acquisition. On January 1, 2019, parent company purchased 10% of subsidiaries' outstanding ordinary shares for 100 pesos per share. The equity instruments were designated as financial asset at fair value through profit or loss. On this date, the shareholders' equity of parent and subsidiary company are as follows. So the first transaction is the purchase of 10% outstanding ordinary shares. So since the purchase is below 50%, there's no control upon the acquisition of the 10% outstanding ordinary shares. Moreover, since the purchase is also below 20%, there is no significant influence. So how do we account for the 10% investment of parent company in subsidiary company? So it shall be accounted for as designated by the parent company as a financial asset at fair value through profit or loss. First, let us determine the number of shares purchased by the parent company. So since the subsidiary company has a total ordinary shares of 5 million pesos at par value and the par value is 50 pesos per share, so the total number of issued shares of the subsidiary company is 5 million divided by 50 pesos. So the number of issued shares of the subsidiary company is 100,000. Then the subsidiary company has a treasury share of 25,000 pesos, which is at cost of 5 pesos per share. So how many shares are in the treasury? So the treasury shares is 25,000 divided by 5 pesos. So the number of shares in the treasury is 5,000. And that will give us a 95,000 ordinary shares that is outstanding. So the outstanding ordinary shares of subsidiary company is 95,000 and 10% of this is purchased by the parent company. So the number of shares purchased by parent company is 9,500 ordinary shares. Remember that the 9,500 ordinary shares came from the outstanding ordinary shares, which means these were previously issued by the subsidiary company. So what is the effect of the purchase of the 9,500 shares in the equity of the subsidiary company? The answer is there is no effect on the total shareholders' equity of the subsidiary company because of this acquisition of 10%. because this will not result to an increase or decrease in the shareholders' equity of the subsidiary company, because this is not an issuance of shares by the subsidiary company. Remember that the 9,500 were all from the outstanding ordinary shares of the subsidiary company, which means these were already previously issued. So what happens is only a transfer of ownership from the previous owner or previous shareholder to the parent company. Now, let's prepare the journal entry. So in the books of the parent company for 2019, January 1, the entry would be a credit to cash. So if the problem is silent, the purchase price or the payment is in the form of cash. So the purchase price is 100 pesos per share. So the total cost is 9,500 times 100 pesos. So the total purchase price is 950,000 pesos, and this will be debited to trading securities, or you may use the account title financial asset at fair value through profit or loss. In the subsidiary company's books, there is no corresponding entry. Again, this is not a new issuance of ordinary shares by the subsidiary company, because if this is a new issuance, this will increase the issued shares and the outstanding shares of the subsidiary company. Again, remember that the 9,500 only involves a transfer of ownership from the former shareholders to the parent company. So the only effect on the subsidiary company is only a change in the list of the names of its shareholders. Next paragraph, on February 1, 2020, the parent company purchased additional 19,000 ordinary shares from the subsidiary's outstanding ordinary shares at 90 pesos per share. On this date, the parent company obtained significant influence over the subsidiary company. So since this is a transaction that occurred in 2020, first let us look for additional transactions that occurred in 2019 that is related to our investment of 10% in the subsidiary company. So we have an additional information that states that the parent and subsidiary company reported the following. So here, we are presented the dividend declared, the net income, and the fair value per share as of December 31 of the parent company and subsidiary company for the 3-year period starting 2019 until 2021. So what is the effect of this financial information on our investment to subsidiary company? Since the financial instrument is designated as a financial asset at fair value through profit or loss, dividend received by the parent company from the subsidiary company shall be accounted for in P&L. So since the subsidiary company declared an 80,000 dividend in 2019, which on April 1, by this time, parent company is already a shareholder of the subsidiary company. That is why parent company is already entitled to the dividend, which is equal to 10%. So the entry would be a debit to cash or dividend receivable in case there's still no collection for 80,000 times 0.10, which is the percentage of ownership. So the dividend received by the parent company is 8,000 pesos. Then our credit is a P&L account, dividend income. So what is the entry in the subsidiary books for the declaration of dividend? So debit will be retained earnings, and credit to cash or dividends payable for a total amount of 80,000 pesos. Moreover, the subsidiary company reported a net income in 2019 of 855,000 pesos. So, what is the treatment of net income of the subsidiary if our investment is a trading security? So, for a financial asset at fair value through profit or loss, the net income of the investee is ignored. However, the entry in the subsidiary company would be a debit to income summary account and credit to retained earnings for 855,000 pesos. In addition, there is an information about the fair value per share of the ordinary shares of the subsidiary company for 120 pesos. Since the financial instrument is designated at fair value through profit or loss, any changes in the fair value of our equity instrument shall be accounted for in the investor's books in P&L. So this requires us to present our trading securities as of the end of 2019 at fair value, which is 120 pesos per share. So the trading securities as of December 31, 2019 should be 9,500 times 120 fair value per share. So the total is 1,140,000 pesos. However, the carrying amount of our trading securities is 950,000 pesos, which is the purchase price. This means that there should be an increase or an unrealized gain from change in fair value of 190,000 pesos, which is 1,140,000 pesos less 950,000 pesos. So by the end of the year, additional entry should be recorded in the parent's book by debiting trading securities for 190,000 pesos and crediting unrealized gain from change in fair value also for 190,000 pesos. So there is no corresponding entry in the subsidiary books for the changes in fair value of its ordinary shares. So this will be our entry for 2019 in the parent and subsidiary books. Now let's proceed to 2020 transactions. As we have read in the second paragraph, on February 1, the parent company purchased additional 19,000 ordinary shares from the subsidiary's outstanding ordinary shares with a purchase price of 90 pesos per share. On this date, the parent company obtained significant influence over the subsidiary company. So if the parent company obtained significant influence, we assume, for academic purposes, that the percentage of ownership of the parent company is 20% or more. Because for academic purposes, significant influence is obtained if the percentage of ownership is 20% to 50%. So let us check if the percentage of ownership upon the acquisition on February 1 will increase the percentage of ownership of the investor exceeding 20%. The previously held interest of the parent company is 9,500, which was purchased on January 1, 2019. Then we have an additional shares purchased on February 1 for 19,000 ordinary shares. So the total shares owned by parent company is 9,500 plus 19,000. The total shares owned by the parent company is 28,500. So 28,500 divided by 95,000 subsidiaries outstanding ordinary shares. This will give us a percentage of ownership of 30%. So here, the percentage of ownership revised after the second acquisition is 30%, which is more than 20% but below 50%. So again, for academic purposes, significant influence is obtained if the percentage of ownership is 20% up to 50%. Again, the acquisition of the 19,000 ordinary shares on February 1 will have no effect on the total outstanding ordinary shares of the subsidiary because this is not a new issuance of ordinary shares by the subsidiary company. This is only a transfer of ownership from former shareholders to the parent company. The only effect of this transaction on the subsidiary company is a change in the list of names of all its shareholders. Now let's prepare the journal entry. So since there is a significant influence, the debit would be investment in associate, then credit cash. For 19,000 ordinary shares times 90 peso purchase price. So the total acquisition or the total purchase price is 1,710,000 pesos. Since we have a previously held interest of 9,500, how it should be accounted for? Since the parent company already has a significant influence over the subsidiary company, the previously held interest shall no longer be recorded under the account trading securities. It should be reclassified as investment in associate. We need to reclassify the trading securities at fair value, and any changes shall be accounted for in the profit or loss. So before the trading securities will be reclassified to investment in associate, we will recognize the change in the fair value of the ordinary shares. The trading securities has a total of 9,500 shares, and then multiply this by the fair value as of February 1. So since the purchase price of the 19,000 ordinary shares is at 90 pesos, we will assume that the fair value of the ordinary shares of the subsidiary company by February 1 is also 90 pesos. So the fair value of the trading securities as of February 1 is 855,000. Then, the trading securities carrying value as of December 31, 2019 is 1,140,000 pesos. So from 1,140,000 pesos, it shall be decreased to 855,000 pesos. So there is an unrealized loss from change in fair value. So 855 less 1,140,000, the decrease is 285,000 pesos. Since there is a decrease, the entry will be a credit to trading securities for 285,000 pesos, and our debit will be unrealized loss from change in fair value. The amount is also 285,000 pesos. So after this entry, the trading securities now is already at 855,000 pesos, and the remaining 855,000 pesos shall be reclassified to investment in associate account. So upon reclassification, the entry would be a debit to investment in associate at 855,000 pesos. Next, the credit will be trading securities, also at 855,000 pesos. So after the reclassification entry, the total investment in associate will amount to 1,710,000 plus 855,000. That will give us a total amount of 2,565,000 pesos. So starting February 1, the investment in associate account has a value of 2,565,000 pesos. And this is accounted for using the equity method. Now, let us look for additional transactions that occurred in 2020 that has an effect on our investment in associate. Since the investment in associate is accounted for under the equity method, any dividend received by the investor shall not be recorded as a dividend income and presented in P&L. A dividend that is received by an investor from an investee, which is an associate, shall be a reduction from the investment in associate account, while the net income reported by the subsidiary will be an increase in the investment in associate account of the investor. However, if there is a net loss, it shall be a decrease in the investment in associate account. The fair value per share as of December 31 in 2020 is no longer recognized under the equity method. Now, let us prepare the entry on April 1 upon the receipt of the dividends from the subsidiary company. So the entry will be a debit to cash for 120,000 pesos times the new percentage of ownership, which is 30%. So the total dividend is 36,000 pesos. Then our credit is investment in associate at 36,000 pesos. Now for the net income of the subsidiary. The net income of the subsidiary as of for 2020 is 741,000 pesos. And it states that the net income is earned evenly during the year. Since we obtained significant influence on February 1, we only recognize our share in the net income of the subsidiary starting February 1, the time when we obtained the significant influence. So the journal entry would be a debit to investment in associate for 741,000 pesos times 11 months, because we obtained significant influence on February 1, so that will give us 11 months of significant influence divided by 12 months. So the total net income of the subsidiary company starting February 1 until December 31, 2020 is 679,250. However, our percentage of ownership is only 30%. That is why we need to multiply this by 30%. So our share in the net income of the subsidiary starting February 1 until December 31 is 203,775. Then our credit is to investment income, also at 203,775. After this, the total investment in associate that will be presented in the December 31, 2020 balance sheet will be, so the investment in associate December 31, 2020 will be 2,732,775. That is computed by the amount of investment in associate as of February 1, which is 2,565,000 pesos, which is the total of 1,710,855 pesos. Then, less the 36,000 dividend received from the subsidiary company, then plus 203,775, which is the share of the parent company in the net income of the subsidiary company from February 1 until December 31. So the total investment in associate as of December 31, 2020 is 2,732,775. So let us prepare the entry in the subsidiary books for the dividend declaration. So the entry would be debit to retained earnings for 120,000 pesos. Then a credit to cash also at 120,000 pesos. For the net income, the debit will be income summary at 741,000 pesos and a credit to retained earnings also at 741,000 pesos. Now, let's proceed to transactions that occurred in 2021. So, on June 1, 2021, the parent company purchased additional 55,500 ordinary shares from the subsidiaries for 110 peso per share. The additional acquisition were obtained from the subsidiaries' treasury share balance, 20,000 from unissued shares, and the remainder from the outstanding ordinary shares. On this date, the parent company obtained control over the subsidiary company. Since the parent company obtained control as of June 1, 2021, we assume that the parent company's additional acquisition will result to a percentage of ownership that is more than 50%. Because for academic purposes, control is obtained if the percentage of ownership is more than 50%. Now let us compute the revised percentage of ownership. First, let us determine the total number of ordinary shares the parent company owns after the June 1, 2021 acquisition. The previously held interest of the parent company has a 28,500 ordinary shares. Then, on June 1, 2021, the total additional acquisition is 55,500 ordinary shares. So the total ordinary shares owned by the parent company is 84,000 ordinary shares. Next is, let us compute for the outstanding ordinary shares of the subsidiary company. The outstanding ordinary shares of the subsidiary company prior to the June 1, 2021 transaction is 95,000 shares. Then, as a result of the transaction, according to the information, the 55,500 ordinary shares came from the subsidiary's treasury share balance. So the number of shares in the treasury of the subsidiary company is 5,000 shares, which means that the 5,000 shares were reissued on June 1, 2021. So the 5,000 ordinary shares were all reissued from the treasury shares. And in addition, 20,000 from unissued shares, which means the subsidiary company issued new shares for 20,000. So the newly issued shares is 20,000. So this will increase the total outstanding and issued ordinary shares of the subsidiary company. Next is, the remainder came from the outstanding ordinary shares. So which means the remainder of 55,500 less 5,000 and less 20, which is 30,000 ordinary shares, were from the outstanding ordinary shares of the subsidiary company, which means that the 30,000 ordinary shares were acquired by the parent company from the previous shareholders of the subsidiary company. Hence, this will have no effect on the total number of shares of the subsidiary company. So the total outstanding ordinary shares of the subsidiary company after the June 1, 2021 transaction is 120,000 ordinary shares. And since the total shares owned by the parent company is 84,000, and the total shares outstanding of the subsidiary company is 120,000 shares, therefore, the revised percentage of ownership of the parent company is 70%. Since the percentage of ownership after the June 1, 2021 acquisition of additional shares is more than 50%, The parent is now called the acquirer because control is obtained from the subsidiary company. Now, let us record the acquisition of additional 55,500 shares. So since the parent company already has a control over the subsidiary, the account title that should be used is the investment in subsidiary. For 55,500 times the acquisition cost per share of 110 pesos per share, or 6,105,000 pesos. Then credit to cash. Also at 6,105,000 pesos. Now, the previously held interest of 28,500 shares that is recorded under the investment in associate account should be updated and subsequently reclassified to the investment in subsidiary account. Before we reclassify the investment in associate account to investment in subsidiary, we first update the carrying value of the investment in associate account until June 1, 2021, because there are transactions that occurred from January 1, 2021 until June 1, 2021 that has an effect on the investment in associate account. So first is the dividend declared by the subsidiary company in 2021 of 150,000 pesos. So the journal entry in the parent company is debit cash for 150,000 pesos times 30%, because by this time, April 1, the date of declaration or payment, the percentage of ownership of the parent company is still at 30%. So 45,000 pesos. Then the credit would be investment in associate. Also at 45,000 pesos. Next is the recognition of the parent on its share from the subsidiary's net income starting January 1 until June 1, 2021. The journal entry would be a debit to investment in associate. Since the net income of the subsidiary in 2021 is 1,080,000 and the parent company has a significant influence over the subsidiary starting January until June 1 of 2021, which is 5 months, we will divide this by 12, then multiplied by 5 or 5 months. So the total net income of the subsidiary from January to June 1 or May 31 is 450,000 pesos. But since the parent company only has a percentage of ownership by this time of 30%, we multiply 450,000 by 30%, which is 135,000. So the share of the parent company in the subsidiary's net income from January 1 until June 1, the time of significant influence, is 135,000 pesos. Then the credit will be investment income. Also at 135,000 pesos. So after all these transactions, as of June 1, 2021, the balance of the investment in associate will be 2,822,775, which is the total of the beginning balance of investment in associate of 2,732,775 plus the dividend received on April 1, 2021 and the investment income from January to June 1, 2021. Now, let's record the corresponding entry in the subsidiary's books. For the dividend, the entry would be a debit to retained earnings for 150,000 pesos. Then the credit is cash or dividends payable, also at 150,000 pesos. Now, for the net income, from January to June, we debit income summary. For the net income starting January to June, which is 1,080,000 divided by 12 times 5 months, or 450,000 pesos, and the credit is retained earnings. Also at 450,000 pesos. Now, let's proceed to the reclassification of the investment in associate account on June 1, 2021. Since the investment in associate account has a balance of 2,822,775 as of June 1, 2021, this will be reclassified to investment in subsidiary account on the same date at fair value. Since the acquisition cost of the shares on June 1 is 110 pesos, we will assume that the fair value of the shares of subsidiary company as of June 1, 2021 is 110 pesos. So upon reclassification, the journal entry would be a debit to investment in subsidiary. For 110 pesos, which is the fair value, times the number of shares previously held, which is 28,500. So the total is 3,135,000 pesos. And the credit is investment in associate at 2,822,775, which is the carrying value upon reclassification. Then we have an additional credit of 312,225, which is recorded in P&L. So again, if there is a reclassification from investment in associate to investment in subsidiary, any difference between the fair value and the book value shall be recorded in profit or loss. So this will be recorded under the account gain on reclassification. So after this entry, the investment in subsidiary account will have a total of 9,240,000 pesos. Now, what are the corresponding entries in the subsidiary company? So the journal entries in the subsidiary company will only include the reissuance of the 5,000 treasury shares and the new issuance of the 20,000 ordinary shares. The remaining 30,000 ordinary shares, which were acquired from the former shareholders of the company, has no effect in the subsidiary's books. So first, let us record the entry for the reissuance of treasury share. So the entry will be debit cash for 5,000 shares times the reissuance cost of 110 pesos. Then credit treasury shares at 5,000 pesos times the cost of treasury per share of 5 pesos per share. So the total credit is 25,000 pesos. Then credit of 525,000 pesos for share premium treasury shares. Next is the issuance of 20,000 ordinary shares. So debit cash at 20,000 ordinary shares times 110 peso per share. Then credit ordinary shares at 20,000 ordinary shares times par value of 50 pesos per share. So the total par value is 1 million pesos. Then we have an additional credit of 1,200,000 pesos credited to ordinary share premium. Now, these are the journal entries related to the acquisition of additional shares on June 1, 2021, where the parent company, who is the acquirer, obtains control over the subsidiary. Since the parent company obtained control over the subsidiary company on June 1, 2021, the acquisition date is June 1, 2021. So let us determine the goodwill or bargain purchase gain that resulted from the business combination as of June 1, 2021. So let us prepare the table for determination and allocation of excess. Now let's start with the acquisition cost. So the total acquisition cost of the parent company, who is now the controlling interest, is 6,105,000 plus 3,135,000 or 9,240,000. So this is the controlling interest at 70%. Since the acquisition is less than 100%, so we have an NCI or non-controlling interest of 30%. So since the acquisition is 9,240,000, which we will assume at fair value of the controlling interest as of June 1, 2021, the total fair value of the firm is 9,240,000 pesos divided by 70% or 13,200,000 pesos. So the total value of the firm is 13,200,000 pesos. Take note that the 13,200,000 pesos is the fair value of the firm, not the fair value of net assets of the subsidiary. So the fair value of the non-controlling interest is 3,960,000 pesos. So this is the fair value of NCI. Now let's compute for the book value of the subsidiaries or the acquirees' net assets. So how much is the book value of acquirees' net assets? Of course, as of the acquisition date or June 1, 2021. Since we have no data about the assets and liabilities of the acquiree as of June 1, 2021, we will use for the computation of book value of net asset the shareholders' equity of the subsidiary company. So how much is the shareholders' equity of the subsidiary company as of June 1, 2021? Based on our problem, we have a shareholders' equity of both company. However, this is on January 1, 2019. We need the shareholders' equity balance of the acquiree as of June 1, 2021. So starting from 7 million, we will include all transactions from 2019 until 2021 that has an effect on the shareholders' equity of the subsidiary until June 1, 2021. So let us now compute the shareholders' equity of the acquiree on June 1, 2021. So here is the shareholders' equity of the subsidiary as of January 1, 2019. So we will add all the transactions that occurred in 2019, 2020, and 2021. So this is the shareholders' equity of the acquiree as of January 1, 2019. So let's add all the transactions that occurred in 2019 until June 1, 2021 that has an effect on the shareholders' equity. So first is the dividend. So the dividend that will be included is the 80,000 pesos, 120,000 pesos, and the 150,000 pesos because the 150,000 pesos was declared on April 1. So which means the dividend of 150,000 pesos was already declared prior to the acquisition on June 1, 2021. So the total dividend is to be deducted is 350,000 pesos. Now, let us compute for the net income from January 1, 2019 until June 1, 2021. So the total net income that will be included is the total of 855,000, 741,000, and 5 months of 1,080,000 pesos times 5 divided by 12. So the total net income is 2,046,000 pesos. Now let us include the transactions that has an effect on the share capital of the subsidiary company, which is an increase in 1 million for ordinary share and 1,200,000 for share premium. Then the reissuance of treasury share that resulted to an increase of 25,000 and an additional credit to treasury share premium for 525,000 pesos. So the June 1, 2021 balance of the shareholders' equity of the subsidiary company is 11,446,000 pesos. So this is the composition of the shareholders' equity. The ordinary shares is already 6 million. Share premium is 1,400,000. Then we have a treasury share premium of 525,000. Retained earnings now is 3,496,000. Other comprehensive income is 25,000 and treasury shares is 0. So now the book value of the acquiree's net assets is 11,446,000 pesos. Then let's distribute the share of the controlling interest and non-controlling interest on the book value of the acquiree's net assets. So the share of the NCI on the book value is 3,433,800, while the controlling interest is 8,112,200 pesos. So the excess over book value has a total of 1,754,000 pesos. Now, after this, let us account for the fair value changes. So the fair value changes are the assets and liabilities of the acquiree that have a book value different from its fair value. So based on the additional information on our problem, all assets and liabilities of the subsidiary company at acquisition date have fair values that approximates book value, except for the following. So the equipment has a cost of 1 million and with an accumulated depreciation of 200,000 pesos, which means that the carrying amount of the equipment is 800,000 pesos. However, the fair value is 810,000 pesos. For bonds payable, the acquirer's bonds payable has a book value of 2 million pesos. However, there is a fair value of 1,900,000 as of June 1, 2021. So how do we account for these fair value changes? So the fair value of the equipment is 810 and the book value is 800,000. There is a difference of 10,000 pesos, which is an undervaluation because the book value is understated compared to the fair value of 810,000 pesos. So what is the effect of the 10,000 peso difference from the excess over book value? So the difference shall be deducted. So 10,000. Then the share of NCI, then the share of the controlling interest is 7,000 pesos and 3,000 pesos. Now, for the bonds payable, it has a difference of 100,000 pesos. So from a book value of 2 million, it should be decreased to 1,900,000. Of course, to decrease a liability, it should be a debit. So debit bonds payable in order to decrease by 100. Then, the 100 has an effect of decrease on goodwill. So this will be, again, a deduction, which is the difference between 2 million and 1,900,000. Then, let's get the share of the NCI and the controlling interest. So after this, let's compute for the difference. So we have a positive 1,644,000 pesos, and this is the goodwill. So the total goodwill is 1,644,000 pesos. This will be recognized if we are using the full goodwill approach or the fair value approach, while the goodwill to be recognized is only 1,150,800 if we are using the partial goodwill approach, which is under the parent theory. Since June 1, 2021 is the acquisition date, let's prepare the working paper eliminating entry in the preparation of the consolidated financial statement. So the working paper eliminating entry is aimed to eliminate the investment in subsidiary account and recognize the non-controlling interest. Again, the non-controlling interest is only recognized if the acquisition or the percentage of ownership is less than 100%. So the investment in subsidiary that will be eliminated have a balance of 9,240,000 pesos, while the non-controlling interest that should be recognized is 3,960,000 pesos. Of course, under the full goodwill approach. So the elimination of the investment in subsidiary account and the recognition of the non-controlling interest is composed of the following: the book value of the acquiree's net assets, the fair value changes, and the goodwill or bargain purchase gain. The share of the investment in subsidiary or the controlling interest is 8,012,200, while the share of the non-controlling interest is 3,433,800. The fair value changes is 110,000 pesos, which includes the 10,000 and 100,000 for the equipment and bonds payable respectively. So the share of the controlling interest in the fair value changes is 77,000, while the NCI has a share of 33,000 pesos. Then for the goodwill, the share of the controlling interest is 1,150,800, while non-controlling interest is 493,200. So these are the composition of the 9,240,000 for the controlling interest and the non-controlling interest of 3,960,000 pesos. Now let's prepare the working paper eliminating entry. First, let us eliminate the book value of the acquiree's net assets. So this is the total shareholders' equity of the acquiree as of June 1, 2021. What are the shareholders' equity accounts of the acquiree as of June 1, 2021? So these are the composition of the shareholders' equity of the acquiree as of June 1, 2021, and all of this will be eliminated in the working paper entries. So the entry will include a debit to ordinary shares, share premium, treasury share premium, retained earnings, other comprehensive income. For 6 million, 1,400,000, 525,000, 3,496,000, and 25,000 pesos other comprehensive income. So these are the debits. This is the shareholders' equity of the acquiree as of June 1, 2021 that has a total of 11,446,000 pesos. Now, let us recognize the fair value changes. So this only includes equipment and bonds payable. First is the equipment. Always remember that in recognizing the fair value changes for an asset with a corresponding contra asset, first is to eliminate the contra asset account. In this case is the accumulated depreciation. So to eliminate the accumulated depreciation, we need to debit 200,000 pesos. So if we debited the accumulated depreciation of 200,000 pesos, the balance of the equipment is 1 million pesos. However, the fair value should be 810. So if the fair value is 810 and the equipment is recorded at 1 million, we need to have an additional credit to decrease the equipment by 190,000 pesos. So we have a credit for 190,000 pesos in the account of equipment. Again, by debiting accumulated depreciation, this will result to an equipment with a value of 1 million. But since the fair value is 810, we need to decrease the equipment account by 190,000 pesos. So after this entry, the equipment that will appear in the consolidated financial statement will be 810,000 pesos. Next is the bonds payable. The bonds payable in the books of the acquiree is 2 million. However, the fair value is 1,900,000 pesos, which means there is a decrease in the liability or a discount on bonds payable. Discount on bonds payable is a debit for 100,000 pesos. So these are the entries for the book value and the fair value. Now, the goodwill. So for the goodwill, since we are using the full goodwill approach, the total goodwill that should be recognized in this consolidated financial statement is 1,644,000, which is again a debit. So 1,644,000. Since we already recognize the fair value changes, the goodwill, and we already eliminated the shareholders' equity of this acquiree, now we eliminate the investment in subsidiary accounts. So credit investment in subsidiary for 9,240,000 pesos and credit non-controlling interest for 3,960,000. Then let's check whether the entry is balanced. So the entry is balanced. So this is the eliminating entry. As of acquisition date. So what is the consolidated shareholders' equity as of June 1, 2021? So always remember that the shareholders' equity in the consolidated financial statements at acquisition date is always the shareholders' equity of the parent company. So what is the shareholders' equity of the parent company? Let us now compute. So this is the shareholders' equity of the parent company on January 1, 2019. Now let's include all the transactions that has an effect on the shareholders' equity of the parent company. This includes the dividends. So the dividend that will be included is only the 96,000 pesos and 144,000 pesos. The 180,000 pesos is not included since the acquisition date is only on June 1, 2019. So the total dividend that should be deducted is 96,000 pesos plus 144,000 pesos. Next is the net income. The net income that will be included is composed of 1,026,000 pesos, 889,200 pesos, and the 5 months of 1,296,000 pesos. So the total is 2,455,200. So since there are no other transactions affecting the other equity accounts, let's get the total. So the total shareholders' equity of the parent on June 1, 2021 is 13,765,200. So remember that the consolidated shareholders' equity that will appear in the consolidated financial statement shall include the shareholders' equity of the parent company as of the acquisition date. So that includes the ordinary shares of the parent company for 7,500,000, share premium of 500,000, retained earnings of 5,215,200, other comprehensive income of 600,000, and treasury shares of 50,000 pesos. Aside from the parent's shareholders' equity, since the parent has an ownership of less than 100%, the consolidated shareholders' equity shall also include the non-controlling interest. So the non-controlling interest that we have computed in our eliminating entry is 3,960,000 pesos. So the consolidated shareholders' equity in the consolidated financial statement will be 17,725,200. So this is the discussion on the accounting for step acquisition or business combination that is achieved in stages.